When an advisor wants to monetize their life's work, we do focus obviously on the recurring and all of those quantitative fundamentals, but we remind them, you're not just managing money, you're managing a business.
Mm-hmm.
So what's proprietary that adds value to your enterprise? Your standard operating procedure and the consistency and the loyalty that creates, competitor proofing clients, capturing money in motion, advocacy. Those are key performance indicators. And then the relationship management piece. How deeply embedded are you into the family tree? I'm curious, do you play a role in the practice management and relationship management elements, or do you spend most of your time on the technical aspects of positioning for the transition?
It's usually the latter. And if we had an engagement with an advisor or a full business where they wanted to do more of the in the weeds kind of practice management type work, more of like the coaching work, I'd probably just pass along your email address and tell them to reach out to you. We have to be very knowledgeable about what are the value drivers, what's going to put you at the top end of the multiple range, what have the best advisors we've worked with done to most successfully position themselves. So we can kind of give them the framework, the things to work on, but we don't get in the weeds with trying to help them actually impact change on those types of items. And the only other thing I would add to your list, which is right, is organic growth net of market appreciation, aside from the size of the business, is by far the biggest driver of how valuable a business is. If a firm can grow, they're growing 8-10% per year or more, absent market appreciation, that's going to be a premium property. And we've seen businesses that manage half the assets as a larger counterpart get a higher multiple than because they're growing that much more. And it's not rocket science, especially if it's a private equity deal or it's an RIA who's acquiring the cash flow of the business. I think if a business in this industry every 5 to 7 years, I've heard, doubles. If a business grows, I think it's 8% per year, which is pretty much the return of the S&P 500, it can pretty much double. So if a business sustainably can grow, it's going to mean a far quicker return on investment for the acquirer. And that acquirer could be a private equity sponsor, it could be a strategic buyer, it could be a bank. Doesn't matter what segment of the industry, firms are going to pay more for properties that can grow organically, net of what the market's going to do.